So I'm Derek Griffin. I work for Munich RE, and if you were like me when Munich RE contacted me, it is not Munich Renewables. It is Munich Reinsurance. So I was definitely confused when I first heard the word Munich RE. And reinsurance is insurance for insurance companies. So it's a very integral part, especially when it comes to climate change. And just a little bit, everyone always asks Jeff, why is the insurance industry here at a bioeconomy event? Well, as we know, climate disasters and climate catastrophes are the #1 source of losses to the insurance industry. And a company like Munich RE, we have been modeling climate change for over 50 years. Of the 40,000 employees, we have thousands of scientists and engineers. I myself am a chemical engineer. I'm the risk analyst for the bioeconomy team within Munich RE. And we have very sophisticated climate models. People come to Munich RE globally saying what is happening with the climate. So that's why Jeff invites us here to talk today about the impacts of climate change and the impacts on the insurance market. And so this is just a very recent photo, and again, this isn't like a catastrophic climate event. The reason why we put it up there is that there was a big climate week in New York City recently. And the reason why I put this up there, so the UN Secretary General Guterres was there, and he commented that we are decades behind in the energy transition. Right, decades behind in transitioning away from fossil fuels. Now, and we all know that fossil is not going away anytime soon, and maybe not in our lifetimes, but we really need to accelerate the transition away from this. And so this was actually happening in New York City during the New York City climate event, so it really kind of hit home, what is happening here. And if you can see this, I know there's a lot of data here, but this is really just all the major NatCat events in the first half of 2023. And you can barely see, but there's a lot of dots on here. And to highlight that the total losses were $110 billion in the first 6 months of this year, the highest amount recorded to date. One challenge is that less than half of that was insured or underinsured. So of the $110 billion economic losses in the world through the first 6 months, about $50 billion was actually insured. So if you look at a lot of the markets, particularly the earthquakes in Turkey and Syria, these places are underinsured or uninsured. So these are complete total losses in these industries, in these areas. And then, of course, if you see all the increase in convective storms, hurricanes, tornadoes, wind events, not just the intensity, but also the severity. Particularly if you look at what's happening in Texas. The hail, which used to be a few centimeters in diameter, there was multiple hailstorms reported this year with up to 30-centimeter diameter hail, a foot, bigger than the size of a grapefruit. Now you can imagine what that will do to your chemical facility, your bioeconomy facility, particularly to PV, which I'll touch on next. And so how is climate change impacting the insurance market? Now this is happening for all of us, right? If anybody is here, there was somebody from San Diego, or if you're living in California, in Florida, and even parts of Canada, your homeowner's insurance costs are going up, right? This is not just inflation, but this is really due to the catastrophic losses the insurance companies are paying out. So if you're living in California in certain regions, you cannot get forest fire protection as part of your homeowner's insurance. Same thing in Florida with flood coverage. This is now happening in Canada. Insurers are pulling out of these markets completely. The homeowners insurance market in Florida is pretty much gone. They pretty much have all exited, and everybody's trying to figure out how they're going to insure their homes in Florida moving forward. This is a big problem. And then what you see here, so this is actually related to commercial property insurance. So this is directly related to the Scaling Up conference here. So if you're a project developer or a project owner or even an investor, your commercial property insurance for your facility, the costs have been increasing quite significantly. So what before was kind of a small line item in your financial model, those costs are going up and need to be paid attention to a little bit more. More concerningly, in my view, so we work on all sorts of projects, which I'll discuss. Our projects are now having a hard time even placing their property insurance. The capacity for coverage is gone down because the insurance companies are now having to pay out all these natural climate-related insurance claims. But the other big problem is that they now have to reserve a lot of capital for expected claims, right? They expected the claims to increase exponentially, so now they have to reserve all their capital. So there's actually reduced capital on the marketplace for your commercial property insurance. So if you're a developer out here, you may have actually gone to your insurance broker and trying to get quotations for your property insurance, and they're having a hard time doing this. So I would just say this is a recommendation to any project developer or owner. While insurance is usually the last thing you think about, including at a conference like this, I would call your insurance broker a little bit earlier than you normally would and try to start placing your property insurance. And the example I wanted to talk about was in the PV market. So I know, it's not directly related to the bioeconomy, but particularly in the US with the IRA, there's additionality requirements, right? So you may have to build your own PV or wind park along with your project. Now, what's happening in Texas and other places in the US with this significant hail increase is completely wiping out these PV parks. Now, a lot of them have insurance, so that yes, you can replace them, but it takes time and cost to do this. Now, what the insurance market is doing, unfortunately, in response to this, is now excluding hail coverage. So we're getting calls daily, we need increased hail coverage. Like, unfortunately, the insurance market is pulling out of hail coverage for PV. This is a huge problem. So now, and what the PV market is doing in response, they're now working on research to increase the thickness of their panels, even by 3 millimeters, right? Just to, as hail gets larger and more frequent, it can stand up to these larger hail events. Well, the problem is that's now increasing the cost of renewables. So while the cost of PV was coming down, if they're now having to design panels to handle climate change, the cost is going to slowly start going back up. So it's kind of a vicious cycle. The renewables that we need to fight climate change are getting more expensive due to climate change. And you can imagine if these panels, add a little bit of thickness to the panel, they get a little bit heavier, how is that going to work for residential rooftop? So nobody knows the answer. I just want to highlight that climate change is not just impacting your own personal insurance, but also impacting the commercial insurance as well. And so what is Munich RE and many other insurers doing in response to this? So as I said, Munich RE has been trying to fight climate change for over 50 years. There were some of the first people to identify climate change as a reason for all these increased losses, and included global warming. I presented on this last year. I won't talk too much about this, but many insurers have announced divestment and moving away from fossil-based resources. So for Munich RE, we are doing a full exit from thermal coal on the asset and on the liability side. So as you can imagine, all insurance companies have a very large capital investment arm. They have to do something with all those insurance premiums. We are moving completely away from thermal coal, divesting completely on the asset and the insurance side. We're doing the same thing as oil and gas. You can see all the targets here. So we have 2025 and 2050 targets to really move out of oil and gas. Now, one thing I commented on last year, particularly for scaling up in Canada, we are excluded on doing anything related to the tar sands currently, including any related infrastructure. So I work in the Green Tech Solutions team, and people always come to us with cleanup technologies. So as an example, there was a tar sand tailings pile cleanup technology. I thought it had great environmental benefits, reduction in waste, reduction in power, but when it comes to an ESG perspective, is this a greenwashing play to allow the tar sands to continue to produce? So Munich RE, very ESG conscious, we are excluded from doing any activities in the tar sands. And I'm sure everybody knows about the large CO2 capture project that's planned for Alberta to pipe all the CO2 100 miles south. So we've been approached for a variety of projects associated to that. Anything that's even closely related to tar sand infrastructure, we're not working on. And so this is just not Munich RE. This is many insurers and reinsurers. And the idea is if the insurance is not available to the oil and gas market, they have to more quickly transition away from fossil, and including on the investment side. So this is one thing that the insurance market is really doing to try to battle climate change. And then specifically for Munich RE, I won't talk about all these specific in detail. We have a capital assets management team. We're putting over 8 billion euros per year into renewable energy investments, mostly wind and solar to date. We're now looking into energy storage, but the bioeconomy is coming next for what our team is looking at. We have an accelerator program, so if anybody here has an EU-based startup technology, definitely recommend you to apply for an incubator in the EU. We have a Munich RE Ventures Fund and a clean tech fund. We issued another green bond last year, a $1.25 billion US green bond. We're now, this is part of this, our extreme weather climate campaign. So some of these slides I showed, we're really trying to raise the awareness for these extreme climate events globally, particularly for the underinsured. It's really, a travesty that some of these regions that have no insurance get completely wiped out. And we have an afforestation project, particularly in South America. But the one I really want to talk about briefly is that we issued this new carbon market product in the EU, specifically related to the emission trading standard in the EU. So what they're doing is that they're allowing investors to buy the carbon allowances. And they're doing this for twofold. One is that they're not retiring them or bundling them off and reselling them. They're holding them. And they're doing this to reduce the supply. for two reasons. One, to then encourage more supply and more renewables to come online, but also to reduce the available supply for emitters to go buy them. All right, so this will then drive the costs up of these carbon allowances, and it make it more expensive for the emitters to actually keep on producing. So it's a pretty interesting investment scheme that they come up with in the EU, and I hope that they expand that. I mean, Canada might not like that, of course, but I do think there are a lot of markets where this type of investment scheme could really try to drive behavioral change. Because as we know, we can try to reduce fossil usage, but it's going to take a global behavioral change for climate change to really be impacted. And then lastly, on what Munich RE is doing. So I talked a lot about this the last couple of years, so I'm not going to get too much into what we're doing on the insurance side. But we offer technology and performance insurance for all renewables, and this is the team I specifically work in, from solar, wind, energy storage, e-mobility. But what we're really making pushes in green hydrogen, power to X, and particularly the circular economy. So everything we hear today, and from sustainable aviation fuel, renewable natural gas, renewable diesel, any sort of forest or bio-based products, this is what we're really focused on in the circular economy. So if you're interested in learning more about the technology performance insurance related to your bioeconomy project, happy to talk at one of the breaks. And then what Jeff always says, okay, how is the insurance always trying to innovate, right? So everyone always says, okay, insurance is kind of like one of those necessary evils, but necessary. So we're always trying to stay on the forefront of climate change initiatives. So with the increasing, at least, discussion on carbon capture in the U.S., and we heard Torchlight talk about the need for it in Canada, we're also trying to develop carbon capture insurance solution programs as well. I will be the first to admit there's really nothing viable in the marketplace. All right, this is one reason carbon capture is going a little bit slow in the U.S., that there's no viable insurance solutions, but this is something that we're working on. And including geothermal. Geothermal I do think is a good sustainable solution, particularly in the EU and Canada, so we are developing solutions for that as well. So that's really what we're working on within Munich RE, and Jeff really wanted me to touch on the IRA. So I'm going to talk about that briefly, and I want to say that a few of the projects that we're working on in Canada are mostly focused in British Columbia, right? Because they have the similar carbon credit program as the LCFS. So we see a lot of RNG projects in BC, and we also see some projects in Quebec, not in Ontario. But the challenge is a lot of these projects are moving across the border to the U.S. I think we've heard about that today. Projects that we're working on 2 years ago are now relocating to the U.S., and we're also seeing a lot of projects relocating close to the border. So there are certain U.S. states where if you export your fuel or export your product, you can capture statewide carbon credits. So I will say we've seen a big shift in the projects in Canada that we've been working on, either moving to the U.S., moving to British Columbia, or moving close to the border. And a lot of that is due to the IRA. So the last topic I want to talk about, so this is not really an overview. I'm not talking about the overview of the IRA. First, I'm not a tax accountant or a tax lawyer, right? So I'm no expert on the IRA, and I don't think anybody is yet because the guidance isn't finalized. But we're seeing a lot of tailwinds from the IRA in the U.S. We heard from Jim Lane, sustainable aviation fuel is at the top of the hype cycle, right? That extra $1.50, $2 per gallon is huge incentives. Hydrogen. So, I attended a hydrogen conference this year. There's been 100 hydrogen projects announced in the U.S. in the last year alone, primarily driven by the IRA. We can get up to $4 per kilogram with all the additional credits. I mean, that's huge. Without the IRA, green hydrogen in the U.S. would not be anything. Same thing with carbon capture. Without the 45Q program, carbon capture in the U.S. is dead on arrival. So the IRA, we're seeing a ton of tailwinds on all these types of renewable projects that you can see here. Now, a big difference that I'm going to touch on a little bit is that what has been existing in the U.S. has really been the investment tax credits for wind and solar. The big switch will be a lot of projects and investors and capital markets are now looking towards the PTCs, the production tax credits. They can be more valuable over the duration of the project. And so what I'm going to talk about here is really how Munich RE and the insurance market really needs to respond from this shift from the ITCs to the PTCs to really enable the IRA. And this is kind of just like a message, not just for any U.S. project developers or project owners, but as Canada tries to develop a similar type of program, here are some of the projected pitfalls that could happen. So, and again, this is not my area of expertise, but very briefly, the traditional tax equity insurance structure is that a tax equity investor like Bank of America or JP Morgan that has a huge U.S. tax bill will go and partially invest into a project. So there'll be an equity sponsor, partial co-owner. And so when those investment tax credits are generated, they're the group that has the large tax bill, and then they can generate those tax credits. And that generally they're buying these tax credits from that project developer, project owner, anywhere from 85 to 95 cents on the dollar. So they're pretty much saving 5 to 15% of their tax bill for a very low risk investment. I mean, for them, it's great. And of course, it's like the largest banks out there doing this. So you got to figure that it's working out pretty well for them. And to date, there's really been almost no losses and no reclaim from the IRA in any of these traditional tax equity structures. So it's actually been really great for these large, very sophisticated tax equity investors. And what Jeff wanted to highlight is, okay, where is this going? So in the last, you can see the numbers here at the bottom. There was about $10 billion in tax equity in 2017. That's doubled in 5 years to $20 billion. This is mostly driven by wind and solar in the US, right? Because that's been the only thing that's generating these tax credits. What's going to happen after the IRA is this is scheduled to anywhere from double to quadruple. So you're talking about $80 billion of available tax equity that's going to be flowing from not the capital markets, but groups like Microsoft, Google. They're going to be pumping money into the economy to get these projects built. So this is a huge opportunity that does not exist currently in the US. I mean, it's going to grow from 20 to 80 billion. So imagine what you could do with 60 billion extra per year of investment into clean renewable projects. I mean, that's really what the IRA is doing. Now, the challenge here, so the last two slides is really just talking about the challenge and how the insurance is really going to try to help unlock the IRA. The big thing that they're doing is this transferability. So as I just described, the existing tax equity structure, you need to be a partial owner of these projects to be able to access these tax credits. With this transferability, anybody with a tax bill can go buy tax credits now under the IRA. So it could be the small shop down the street, it could be a pizza store, it could be anybody. The challenge is this is going to attract a whole new class of investors. Most of them are not going to be the sophisticated Bank of America and JP Morgan types of investors that have tax equity teams. They can go through these contracts. And so if we talk to the capital markets all the time about the IRA, because every project in the US is now incorporating IRA tax credits into their financial models, and they're looking for transferability and to sell these, especially the PTCs. The challenge is there may not be enough buyers out there. There's so many large banks that are going to be buying all these credits. So there's actually a concern that there may not actually be enough buyers out there of these credits. And so one of the challenges here is how you're going to get these unsophisticated buyers on the hook to really get them interested. So there's two risks: legal risk, which is covered by current tax equity insurance, but then there's all these technology risks. So anyone with a project that's looking to get these production tax credits, from your wind park, solar park, hydrogen, RNG, if that facility underperforms, whether the wind isn't blowing or there's a technology risk, you will not be generating sufficient PTCs. And those people trying to buy those tax credits, they're on the hook. So just the last slide. Thanks, Jeff. I see you coming up here. And so what the insurance market could really do to unlock this, so if you have these new class of tax investors, they're going to wonder, if the facility is underperforming, how am I going to get my tax insurance credit back or a tax credit back? This is where the insurance market can really play in. Now, right now, there is no insurance solution for PTCs, right? It's only for the ITCs in the US. So there's going to be a huge gap that the capital markets forecast, particularly trying to get these additional buyers on the hook. And so this is what I just want to say. My last note, Jeff wanted to say, what is the insurance market trying to do to enable the IRA or the impact? Without new insurance solutions, which Munich RE and others are working on, and really try to attract these new additional types of tax equity investors, we may not actually realize the full potential of the IRA. This is a big challenge. A lot of capital markets say you're going to generate hundreds of millions of dollars of credits, and nobody's going to be there to buy them. So I just want to say, last note, insurance, I personally think of it as an enabler. Right, in previous years, we talked about enabling the bioeconomy through our performance insurance. This year, we're trying to discuss just briefly how insurance can also enable the full deployment of the IRA and any comparable programs, particularly in Canada and the EU, as they come out. With that, I'll take any questions. Thank you, Jeff.